All right. Well, thank you for joining us. It's Sarah Catalan. I'm the executive director of OC Tax, and we're here with Sean today to talk a little bit about the insurance challenges that we're having in the residential industry in California. Sean, I wondered just first if you could just introduce yourself and tell us a little bit about the Institute.
Yeah, hey Sarah, thanks for having me. The Insurance Information Institute, or III as we refer to ourselves, we've been around for about 70 years. We were founded by insurance carriers. Our mission is really to be a trusted source of information to help people better understand risk management and insurance. We strive to serve the customer, the policymaker, the media, and industry professionals. So this obviously is an important issue that we've been talking about for some time in the state of California because it is unique in terms of the circumstances. But there are a few things that triggered it that had been happening for a while, but some things actually coming out of COVID that really exasperated the problem.
Mm. Well, I really appreciate you making the time for us today. I think every time you and I connected via email, or if we talked about getting together to talk about this, that day there was some huge breaking news out of California in this industry. So your job is never boring for sure. But we had talked a little bit about kind of the background. Would you mind kind of just catching us up to speed? You know, we're dealing with a crisis in California. But, you know, as you had mentioned kind of before we hopped on, that it didn't start overnight. You know, this has been building for a while. I wonder if you could give us a little bit of background on that.
Yeah, I think, a couple things. The first one is, what's happening right now in the state of California. And just for some perspective, this is when insurance does kick in as what we call the financial first responder. So claims are being paid. We've got, nearly $7 billion in claims being paid. We're encouraging people to call their insurance professional if they have any issues because that's what the industry is designed to do. There's also one of the things that we should talk about is the capital that's on hand. There's enough capital on hand to pay all the claims. There are overlapping systems between the industry's policyholder surplus. We'll probably talk about the FAIR plan and the assessment that it will have, which is a normal thing to do with the FAIR plan, states that have FAIR plans. And then even on top of that is a guarantee system in case any insurer were to, and we don't think that it'll happen in this case, become insolvent. There's a system for making sure that, again, the claims get paid. But I think the other part of what's happening in California and what got us to this point has a lot to do with a couple things. And most recently, something that's been happening across the country and across the world, really, is around inflation. So when we locked up supply chains during the COVID years, 2019 to 2022, locking up those supply chains meant that things weren't readily available. And a lot of those things do involve insurance, replacement items, construction materials. When you have a claim, you need the wood on hand or the concrete on hand to rebuild or the autos on hand to pay the claims. And those supplies were locked up in large part and caused some extraordinary inflation rates. So we were seeing close to double-digit rates of inflation overall, but as it's specifically related to insurance, when you looked at 2019 through 2022, replacement costs related to insurance, homeowners replacement costs in that 3-year period went up 55%.
Oh my gosh.
So that's extraordinary in terms of it. Now we're beginning to see that those replacement costs are leveling to what we would call more normal levels. In fact, we saw even some contraction last year in those replacement costs, but it wasn't anywhere near the 55% level. So you have a state, not just in California, but across the country where things are just more expensive. I think we're experiencing that with everything, but if you pinpoint it to insurance specifically, it was a bigger issue than most other industries in terms of the impact. And so when that type of unprecedented inflation happens, or when you see an extraordinary catastrophe cycle, like you saw in California in 2017 and in 2018, when you see levels like we have seen, the industry, in order to make sure that its underwriting is in check, meaning the expenses that it pays out versus the premium that it brings in, you want those to be at 100 or below in order to get to some level of profitability. With those inflation levels, the industry needed to catch up with it. And the way to have to catch up with it is you have to, if the claims costs are going up, the price of insurance is going to go up along with it. Where California came in, and that again, that's across the board.
Right.
Something that people don't always appreciate either is the industry, especially in homeowners insurance and personal auto insurance, because it is so heavily regulated everywhere. The industry, what we call the combined ratio, the profitability levels, it's not always it's not always there. In fact, if you go all the way back to 28 years back to 1997 for the whole industry, you'd see that it was profitable from an underwriting perspective 8 of those 28 years. So it's a challenge to underwrite in the first place, but then when you're spiking up costs like that, to catch up, you've got to raise the price. Now, where California got itself into issues is the way that the regulatory system was designed, and it dated all the way back to the 80s due to what they call the Proposition 103 in California,
Yes.
is if a insurer wanted to raise insurance prices over 7% every year, then it had to go through what I would call an arduous consumer group led process.
Right.
And so what you were oftentimes seeing is carriers submitting increases for 6.9%.
Right.
But when you see the inflation levels the way they were, the insurer needed larger amounts, and it wasn't able to get those amounts. Either they were not approved by the regulator, or the insurer just knew they weren't going to be improved. And this is where you started seeing them make business decisions to either not renew anymore or withdraw from the state entirely.
Right.
What's important to understand is that these insurers would like to do business in the state of California. It is the largest economy in the US. It's one of the largest economies in the world. That's where insurance thrives, is helping economies grow. But when you are put into a position where you can't get the rate that you need, or the other thing that was happening in California too is insurers weren't allowed to use modeling in their underwriting,
Right.
which in this day and age is everywhere. And there's plenty of evidence to show that it can be very, very helpful to understanding the risk and
Mhm.
also helping the customer understand their risk.
Right.
There are places, and we'll have some research coming out here soon, where you can pinpoint a home with what you could call red alert risk versus not, just down the street from one another in these areas that we're seeing the devastation occur. So with those two areas, this is what was getting California into problems. I would say it had been on the brink of this type of major devastation or insurance crisis for decades, because the way that Proposition 103 was written just made it a unique state. And anytime you were going to have something of this magnitude happen, it was going to trigger a crisis. So for the last few years, they have been working on a new system, but that new system is now in place in January of 2025.
Right.
And in those years where they were talking about changes but not making any, insurers were looking at their business books and saying, "I can't wait any longer. I've got to either put the non-renewals out, or we've got to just pull out of the state entirely." So that kind of sets up the problem and where we're at with insurance.
Yeah.
Hopefully it's helpful.
Yeah, it is. You answered, I think, my first 16 questions all in one. But no, we with the recent fires, because I'm local, what we saw on the news, the most recent fires, I should say, was kind of villainizing the insurance companies, like, oh, they canceled all these policies immediately before the fire. And at OC Tax, what we've been highlighting for the last almost 3 years now is that this has been a problem that is building. What you've alluded to, I mean, I didn't even think of factoring in inflation and how that would affect the insurance market. So it goes back even further than I was talking about. But, I've been talking about this. In 2002, Allstate announced that it would no longer issue new home insurance policies due to the wildfires and the high cost of our regulation. It's the cost of doing business in California. Next year, State Farm did the same. And those were our two largest insurers. Year after that, 2024, the largest two remaining insurers kind of made the same announcement. So, not issuing new policies and canceling policies obviously are two different things, but the largest insurers in the state had made that decision, by 2022, 2023. So it wasn't that something happened immediately before the fires and everybody knew the fires were coming. So they canceled all these policies. Like that's not what happened. So I appreciate you giving us, even more historical context going back to 2019. um, it really has, pushed up the cost of doing business. And now with fewer choices, the consumer has, even fewer options, and those options cover less and cost a lot more. Um, March of last year, I think that is when the governor's office really said, okay, this is at a crisis. We need to do something about this. He had issued an executive order, kind of directing the state insurance commissioner to get on this. And the points that he highlighted were a better rate approval process, which you alluded to, stronger fair plan, and accelerating the implementation of some of the regulations that they have been putting in place. Would any of that have helped, in your opinion, if they had implemented that in March 24? Would any of that have helped the situation we're in now?
Oh, I believe so. Yeah, I think the timing is probably one of the more unfortunate elements that we're dealing with here, insofar as how long it took to get to what we've now seen to be implemented in January 2025 with the new sustainable insurance strategy.
Mm-hmm.
But again, they started that a couple years ago, but in any of those years, what we're seeing in California could have happened. The scientists will tell you the wildfires like we've just seen were inevitable.
Right.
When you have that kind of brush and an existing environment next to a heavily populated area in a dry region that's prone to annual severe winds,
Yes.
something's going to happen there. So it was like I said, so I was sitting on a brink because the reality, if you go back to the insurance rates in the state, we did a study with a peer group of ours, a family member, if you will, the Insurance Research Council, does original research on rates and actually compare, and it looks at all the 56 jurisdictions of insurance in the U.S. and all 50 states, and looks at kind of what is the price of insurance in a percentage to the median home income.
Mm-hmm.
California has actually been below average in
Mm-hmm.
terms of its cost. But I would argue that has been artificially low
Yeah.
because you have to think of it at the price of insurance reflects the risk, it's not the cause. And so if we all can see that wildfires are happening in and around the state year in and year out, that illustrates a higher risk
Right.
than average, right? So that's what you have to factor into the price, and the system wasn't allowing it. And so, I would say, several years ago, it was, there's this desire for people to like to point to the industry of filling its deep pockets. And we can show you in our analysis that, again, from an underwriting perspective, the industry actually makes most of its money through its investments, because in order for that capital to be on hand and keep the promises, it has to invest for the long term, and it has to invest very safely and
Right.
slowly.
Right.
And it's very closely regulated. So that's important to have. The underwriting is the bigger challenge, because it's a shorter term reflection of things, and most of the time on the personal line side of the business, because I mean every state has regulatory scrutiny more so on personal lines than commercial lines. It's
Right.
just it tends to be a little more political. Consumers are constituents.
Yeah.
Prices go up, people aren't happy. That's understandable. But in California, it just became so extraordinary. And this is honestly the Triple I we're trying to explain, because we have other states. That's why the National Conference of Insurance Legislators asked me to come in, because everybody's worried whether or not they're the next California. And
We hear that in a lot of industries, actually, not just insurance, but
but so we're trying to explain, one, the inflation aspect that you talked about, but also just the unique circumstances that compounded the state's problem.
thank you. And you mentioned, kind of segueing into Commissioner Lara's response to this executive order was to release the sustainable insurance strategy the following October. But what he factored in was something you touched on earlier. It requires insurance companies to increase coverage in high risk areas using catastrophic modeling. So you touched on that earlier. Was California the last state, to your knowledge, to implement this, or just towards the bottom?
I'm not gonna, I don't know that I can give you a definitive answer, except for is extraordinary in this day and age that insurers can't use modeling.
Okay.
So it's the only state that I know of that doesn't allow modeling to provide a risk profile because we'll be putting out research in conjunction with an innovative company, insurtech company, Guidewire and Hazard Hub. So.
Yes.
Hazard Hub actually has a system where every property in the United States can have enormous amounts of variables of risk.
Mhm.
There's a tool we provide that allows you to type in any property and you can get 30 variables of risk just to know. But they can very well, in the state of California, will illustrate it, can pinpoint, like I said, those properties that have higher risk. And that's not just to say, hey, you're riskier, and so we're not going to underwrite you. It's actually to say, hey, here are your risks, here's what you need to do to fix it. And this is
Right.
a normal practice. I mean, we have a vacation home in a community up in New England, and we got a notice from the insurance company that we need to fix our trees, or they won't write us again.
Right.
So we've just got to cut down those trees to make
Yeah.
sure that we can keep our insurance. And so that's the type of exchange, though, that modeling can help in terms of where we think the really important shift here, as well as the industry is trying to make this shift with modern technologies, is not just detecting and then repairing after a catastrophe, but predicting and preventing.
Yes.
So with these modeling information exchanges, sometimes we'll hear that the consumer gets a little bit upset about, seeing, having the insurance company having a picture of their roof,
Mm.
uh, which you can get on pretty much any real
Google
estate
Maps. Yeah. Yeah. I
application
can zoom
that
in.
you have. But understanding that risk of roofs and brush and ways that you can prevent, the catastrophe is going to be increasingly important. So that's, one, we've got to rebuild in a more resilient manner, but two, we've got to figure out how to open the lines of communication between the customer so that they can figure out and we can work together to make our communities more resilient.
It's really important. We just renewed our policy and we had to send them photos. We had to go around the whole exterior, the interior,
Yeah.
make sure there was nothing. And we got an A+. So I guess my husband does a good job of clearing all that stuff out, I guess. But I want to switch gears a little bit to talk about reinsurance. So, if you're looking at all of the states that you deal with, from what I've been told, California is one of the few states that doesn't allow for the cost of reinsurance to factor into your rates. Can you touch on that? I don't think that's a term a lot of people are familiar with.
Yeah, it is. It's a very important element of the insurance cycle, and it varies in terms of how much a carrier will use or not in the
Okay.
pricing, right? Because you would imagine a larger carrier doesn't rely as much on reinsurance because it has its own capital on hand, whereas a smaller, that might be the way that it can thrive more. But there's a cost associated to it, and it depends on kind of what your business model is with how much you need it. But it is absolutely necessary in the risk transfer tool system. And so those costs, is a part of the risk. It's
Mhm.
just the same as inflation. It's the same as the brush on your house. These are all variables of risk that have a cost to it. And so in most states, if you're using, when you're using reinsurance as part of your business model, you need to factor that cost into the cost of the consumer's insurance.
Right.
And so California, again, unique insofar as it didn't allow that cost to be. So again, it was just a matter of just these artificial elements were put in and pricing it lower, but it just wasn't a sustainable path.
I really appreciate that because, the insurance industry and how profitability works, if there is any profits, and how you manage the investments. I mean, it is an extremely complex issue. So I appreciate you breaking it down for all of us lay people. Kind of the last issue I wanted to touch on, we've danced around it a little bit, but that's the FAIR plan. So I wanted to talk to you a little bit about that. So in a lot of the news reporting that we heard about the FAIR plan, I mean, number one, I would say most people didn't know what it was before 22. And as they had to start looking for different carriers, a lot of people shifted to the FAIR plan. So we saw in Rancho Palos Verdes, 85% of those plans were owned by those residents more than the previous year. So not 85% of the whole, but 85% more than the previous year due to non-renewals and other factors. So it's almost reported as though it's like a state insurance plan, but that's not the case. So I wanted to see if you could chat with us a little bit about the FAIR plan and kind of explain how that works.
Yeah, absolutely. There are several states with fair type plans, and really, it's a marketplace that exists when traditional insurance channels are not available.
Okay.
In California's case, which you absolutely correctly point out, this is a private company that is regulated by the state that is owned by insurance carriers for the most part,
Mm-hmm.
and so it's unique, but it's unique for the insurance industry per se, but it's not unique for fair plans to not keep a lot of capital on hand. What they will do is if something is triggered in extraordinary circumstances only. I mean, the last one we saw any trigger of any fair plan was 2004 and 5 in Florida,
Okay.
which has a fair plan. They make these assessments. They say, here's the amount of capital we're probably going to need to make sure that everything is running well. And so they will take an assessment, and each of the the insurance companies will then take on that assessment. It'll be divvied out according to their market share, and they will pay into it. But this is something that the industry supports and manages, and then is done hand in hand with the regulator.
Okay.
But in terms of assessments like that, it is normal once the circumstances become extraordinary.
Mm-hmm.
And what we certainly this natural catastrophe cycle was extraordinary and triggered it. But the other important message is that everybody in California can get insurance because the FAIR plan is there. And so that allows for it may not be the price that everybody wants to pay,
Right.
but arguably again, that price is a better reflection of the risk. But one thing I will say is whenever you see a fair type plan be the largest insurer in a state, it's a signal of market issues. So
Mm-hmm.
in Florida, we're beginning to actually see that's another state where we've seen them as the largest insurer in a fair type plan.
Okay.
Their problem was legal reform. Legal system abuse was running rampant in the state. 79% of all homeowners litigation a couple years ago was in Florida for the whole country.
Oh, wow.
So it was a big problem, and it was very costly. And so insurers again were saying if we can't get legal reform here, something's got to give. And so they passed legal reform, and now you're seeing more insurers come back into that state. You're
Okay.
seeing the rates of insurance, the prices of insurance decrease because the risk levels have decreased. So this again is kind of where California can take a lesson that if this sustainable insurance strategy kicks in, we're able to create a more normalized marketplace for insurance.
Mm-hmm.
You will most likely begin to see insurance companies think twice because, as I mentioned when we first started talking, California is a very large economy and the population is growing. And so people need more insurance in this state, as we know. And insurers want to be there. We just have to have the right market conditions.
They do. And I think this is kind of my last question for you. So you mentioned the assessment. We saw, in case people don't know what that is, that the insurance commissioner just approved this $1 billion, increase for the FAIR plan, half of which will be funded by ratepayers. So, $500 million will be funded by ratepayers. But then yesterday or Friday, he just denied State Farm's claim to increase their rates by 20%. So is that kind of, him favoring one over the other, or is it just the amount you think, or it just seems almost like it's not fair. So so the FAIR plan can do a $500 million increase, which will be passed on to ratepayers, but State Farm is not allowed to do an increase, which will be passed along to ratepayers. Am I comparing apples to oranges, or is it more similar?
I would just say it certainly was surprising to see, given the number of years that we've all been working to fix California's marketplace and to acknowledge that, insurance pricing has been artificially low in the state. And then so we talked about the inflation, we talk about this extraordinary wildfire devastation that will have a cost. We need to allow insurers to price that risk accordingly. And we have seen other carriers received the increases. So I don't know all the circumstances, but I would say it was in fact surprising to me, given how much we've learned and where we seem to be moving toward. You want to make sure you keep moving in the right direction.
Right. Absolutely. Well, I know that, as you've said, California is the largest market in a lot of areas. And I know that businesses want to do business here. So hopefully we'll be able to work on that regulation and improve it. So I really appreciate your time again. I know you mentioned you're going to be publishing a study soon. If you ever want to come back, we'd love to have you back and kind of release that study with us here. But we really appreciate your time and breaking it down for us.
Yeah, anytime. We've got a web page right now dedicated to California wildfires. So there's
Oh,
some
great. Can you share
information for
that? Do you
your.
have the website?
You can just go to iii.org.
Okay,
And right on the main page, you'll see it front and center, California wildfires. You can click on that, and there's an explanation of what's happening. There's, some other media interviews we've done just so
great.
people can understand kind of the where people are going, but also just, fact sheets and things like that to just explain the market a little more.
Awesome. That sounds great. Well, thank you again, Sean. We really appreciate it.
Thanks, Sarah.